Hello everyone, welcome back. We are learning subject Entrepreneurship Development Unit 4, and the topics that we'll be learning are financing and accounting, need, sources of finance, term loans, capital structure, financial institution, management of working capital, costing, break-even analysis, network analysis, techniques of PERT and CPM, taxation, income tax, excise duty, sales tax. So first topic we are learning is financing. Financing is the process of raising funds required for starting and operating a business, arranging or providing money for business. So in simple terms, financing is we are arranging some money for starting our business. Accounting is the process of recording and maintaining financial transactions of a business, keeping track of all money related activities. So in a business, when there is a lot of transactions, we need a record to maintain all this, and that process is called accounting. Next topic is need for finance. Why do we need finance? A business requires finance for many reasons: to start a new venture, expand operations, buy equipment, meet day-to-day expenses, or deal with unexpected costs. So in business, there are so many expenses that we need A business requires finance for many reasons: to start a new venture, expand operations, buy equipment, meet day-to-day expenses, or deal with unexpected costs. So in a business, to starting a business also we need money, right? We need some capital, some cost, and for the things that we'll be doing in the business, to buy the required equipments for the machinery, we need finance. Finance is needed whenever immediate availability of sufficient funds may not align with goals or requirement. So we need finance when our funds are not sufficient for the goals that is required to complete. For example, launching a factory needs funds for machinery and materials before any sales arise. So when we are starting a factory, we need finance or funds so that we can set up all the machines and our work gets started even before any sales arise. Sources of finance. Businesses can raise money from internal sources or external sources. So how can we get finance? From where do we get? So there are two types of sources: internal sources and external sources. Internal sources include the owner's savings or retained profits. These are low cost but limited in amount. So internal sources are someone's savings. So if you have some kind of savings, then you can start financing with that savings. Next is external sources, include loans or equity from outside parties. External finance can be short term or long term. So external sources means taking loan from some other people, and this can be either for long term or for short term. Short term sources are used for working capital needs, while long term sources fund expansion or fixed assets. So whatever short term sources are there, from there when we take loans, that is needed for capital needs, like for starting of a business. But when we are taking long term, that can be used for expanding the business or for the fixed assets, which can give us returns later on. Finance can also be classified as debt. Debt means borrowed money to be repaid with interest, or equity, money from owners, investors who expect dividend or profit. So this finance can be classified in two types. One is debt, one is equity. Debt means we are borrowing money and will be returning to them with some interest. Equity means when owner invests some money and they expect some profit from that. For example, banks provide debt finance, whereas issuing shares or using owner's capital is equity finance. So when a bank is giving some kind of money and we have to pay that with interest, that is called as debt. And when we are giving some part of company shares to the bank, that is called as equity. Each source has different cost and suitability. Owners' funds cost nothing in interest, but bank loans carry interest. So all of these sources have different cost and suitability. Depending on our requirements, we can take these loans or finances. We can take help of these finances. So when owner is funding, there will be no interest, right? But when you are taking loans from the banks, we have to pay with interest. Selecting sources depend on business stage, amount needed, and cost of funds. So all this depends on our business, how much amount do we need and what will be the cost of the funds. Next is term loans. Term loans are loans taken from bank or financial institutions for a fixed period of time. So term loans in simple terms means taking loans from bank or some other institution for some fixed period of time, for a particular period of time. These loans are generally used for long-term investments such as purchasing machinery, land or buildings. So why do we buy this? Why do we take these loans? These are for long-term investment. For example, when we are opening a factory, we need lot of machines, right? So for that machinery, we are taking loan, that is known as term loans, or for land or for buildings. The loan amount is repaid in installments with interest. Term loans help business acquire necessary assets without paying the full amount at once. So when we take this loan, we will be repaying this monthly, like with installments with interest, and these help business to buy necessary assets. So that, see, term loans are helpful when we are starting a business or a factory, something like that. And when we take this term loan, you do not have to pay all the money at once. You will be paying some amount of it with loan with installments, like for monthly. Example is when you are paying monthly. Capital structure. Capital structure refers to combination of different sources of funds used by a business, mainly equity and debt. So what is capital structure means? If there is a company or a business, what they do, they take different sources of finances. They take help of different finances. For example, they take equity as well as debt. A proper balance between equity and debt is important to minimize risk and maximize profit. So when we are taking both the equity and the debt, that helps us to minimize the risk and maximize the profit, that we gain more profit when we balance both the things. Too much debt increases financial risk, while too much equity reduces control and returns. So too much debt means when we are taking loan from banks or financial institutions, that creates so much risk, right? And when we are taking too much equity means giving the shares, then we lose control on our company. Hence, an ideal capital structure is necessary for financial stability. So for financial stability, we need a balanced capital structure. Next topic is financial institutions. Financial institutions are organizations that provide financial support to business. So these institutions provide support to the business. They offer loans, credit facilities and financial advice. They also offer the loans when we need, and they give us proper facilities and advices regarding our business. Examples include banks and development institutions. These institutions help entrepreneurs by providing the required capital and guiding them in financial planning. So example for financial institutions are bank and development institutions, and what they do, they help with providing the capital that we need for the business, and also they help us in planning. They play a key role in promoting business growth and economic development. So they also help us in promoting our business and also in economic development. Management of working capital. Working capital refers to the money required for day-to-day operations for a business, such as buying raw materials, paying wages and managing inventory. So working capital means in day-to-day life, what we do, we have to buy raw materials. Suppose for a factory, we need raw materials, right? We need to pay wages for the workers who are working there, and also manage all the things. Proper management, so that is called working capital. The amount we need to handle all those things is called working capital. Proper management of working capital ensures that the business runs smoothly without shortage of funds. So when we manage the working capital properly, this can ensure that our business is working smoothly. It involves maintaining a balance between current assets and current liabilities. So here we involve maintaining balance between assets and the liabilities. Efficient management improves liquidity and profitability. So when we manage it properly, it improves the liquidity and also profits. Next topic is costing. Costing is the process of calculating the total cost involved in producing a product or service. So what is costing means calculating whatever product we are making. So suppose in a factory, if we are manufacturing some kind of product, so costing will be the amount we invested to make that product. This helps in fixing selling price and controlling expenses, helps in identifying areas where cost can be reduced, thereby increasing profits. So when we are producing some kind of product and we are getting to know cost of that product, why do we need to know that costing? So that we can understand the selling price. Like after the product is manufactured or produced, we can analyze the selling price of that product, and also we can analyze where we can reduce the price so that we can gain more profit. Like for example, if we are getting raw materials for some price, for some x price, and we are getting raw materials from other place which is lesser than this, so we can take materials from the place where it is giving at us for less price, and that can increase our profit. Fixed cost stay constant regardless of output. So fixed costs are the ones that are always constant. For example, rent, whatever rent that we are paying for the place is fixed, like not fixed for years, but it is obviously fixed for like months, right? And also the salaries that we'll be giving to our employers. Next, variable cost, change in direct proportion to production. So variable cost changes according to the production, like depending on the product, depending on the raw materials. Semi-variable or mixed cost have both fixed and variable parts. So semi-variable means these have both the fixed and variable cost. Example here is electricity bill has base charge plus usage charge. So you have to pay the base charge as well as whatever we are using for the electricity, right? Next topic is break-even analysis. Break-even point is when total revenue equals total cost. No profit, no loss. Break-even analysis is used to determine the level of sales at which a business neither makes profit nor incurs loss. At this point, total cost equals total revenue. It helps entrepreneurs understand how much they need to sell to cover all expenses. This analysis is useful for pricing decisions and financial planning. So in simple terms, break-even analysis is, so when I'll tell you with example. So when I'm having a factory, for example, I have a factory and I have bought raw materials for some price and I have all the machineries and I'm producing some kind of product, I'm manufacturing some kind of product and selling that product in the market, and I'm gaining profit. Now whatever I have invested for that raw material, for the machinery, for the place, that is equal to whatever I have sold into the market and the profit that I have got. So this price and this price becomes equal. This amount and this amount becomes equal. First is the raw materials, the amount of raw materials, the place that I have taken for the manufacturing and all the things, and after selling the profit I am getting. So these two becomes equal. That point is called break-even analysis. That means at this point our total cost is equal to total revenue. How much I have spent is equal to how much I have gained. So why do we need this? This helps entrepreneurs to understand how much they need to sell. So if I produce some kind of product and if I sell like 100 pieces of it, I know that I am getting cost of all the machinery and all the raw materials. Now I know if I sell more than 100 pieces, I'll get the profit, I'll be in the profit. Till now I am at a place where whatever money I have invested, I am getting that money back. I am not at the profit right now. So this phase is called break-even analysis. So when I calculate this phase, I'll get to understand that after selling 100 products, I am at equal. I'm not getting any loss, I'm not getting any profit. But I need to know this point so that I can produce more products and get profit. So now I know that if I sell more than 100 pieces of that product, I'll be in profit. So this is useful for pricing decisions and financial planning. So this helps in future planning and all the things. Next topic is network analysis. Network analysis is a project planning and control technique used to manage and complete projects efficiently within a given time. So network analysis means planning and controlling the project so that we can complete it in a given time. So there are different techniques for this. It involves breaking a project into smaller activities and arranging them in a sequence to show their relationships. So what we are doing here, we are when we have a project to complete, we are breaking that into small different parts and we are linking them, that after this part I have to complete this, after this I have to complete this. This helps in understanding, and also we are also showing the relationship among this. When this happens, this will happen, like all the relationships between them. This helps in understanding which task must be done first, which can be done simultaneously, and how long entire project will take. So when I divide this into small pieces, I can understand that this part has to be done earlier and this part has to be done later on. And also I can analyze that if some part is going in the background, it is okay. So I can understand all these things after the network analysis. Network analysis is especially useful for complex projects where many activities are interdependent. So when all the when activities are dependent on each other, we need network analysis so that our complex project can be done efficiently and effectively in given time. So PERT and CPM are network analysis techniques. First is PERT, program evaluation review technique. Next is CPM, critical path method. These are techniques, these are network analysis techniques used for planning, scheduling and controlling projects. First is PERT, is mainly used when time required for activities is uncertain. So PERT is used when the activities that we are doing do not have proper time. Like if I am doing some ABC activity and I don't know how much time it will take to complete, at that time I am using this technique. It considers 3 time estimates for each activity. First is optimistic time, minimum, pessimistic time and most likely time. So when I don't know how much time it will take to complete this particular activity, what I do, I have 3 time estimation, like I'm estimating. Optimistic time means minimum time, that this process will be completed in so and so time. The minimum time is this, and pessimistic time is maximum time, like max to max this process will take this much amount of time. Most likely time is the correct time. Using this, an average expected time is calculated. So with all this we calculate some average. This makes PERT suitable for projects like research and development where exact timings are not known. So we use this for research and development where we do not know the exact timing of each activity. Next is CPM. CPM is used when time required for activities is known and fixed. So we are using CPM when we know the time required for that activity to be completed. It focuses on determining the critical path and helps in controlling time and cost. So when we know how much time we need, we can control the time and also the cost. CPM is commonly used in construction and production projects where activity durations are predictable. So we use CPM for the construction and the production where we know how much time will it take for the production. Okay. Next topic is taxation. Taxation refers to compulsory payments made by businesses to government. So whatever business we have, we are paying some amount of compulsory payment to the business, to the government, that is called tax. Income tax, tax paid on income or profits earned by a business. It is calculated based on profit generated during a financial year. So income tax is the amount that we are paying after earning profit in a business. So after selling so and so products, that 100 products or 200 products, I'm getting some kind of profit. So on that profit, whatever on that profit I'm paying the tax, excise duty, and this is calculated during the financial year. Next topic is excise duty. Excise duty is tax imposed on production or manufacture of goods within a country, charged on goods before they are sold in the market. So when I am producing all these products, I have to pay excise duty to the government. Before selling it to the market, I have to pay this. So this is called excise duty. Next is sales tax. Sales tax is a tax laid on sale of goods to customers. It is collected by seller and paid to government. So sale tax is when we are selling goods to the customer, we are collecting some amount of tax in that and it is given to the government. In many cases it is replaced by GST. Concept is similar. So now it is replaced by GST. So this is all about unit 4.